Hello everyone, my name is Zhang Fan. Today, I will present my thesis titled Analysis and Forecast of BYD's Debt Repayment Capacity under Strategic Expansion Background, based on indicator system and machine learning. In the rapidly evolving new energy vehicle industry, BYD stands as a paramount entity. My research focuses on a critical question. How does aggressive strategic expansion impact a firm's financial health? Before we dive into the specific factors, here is the abstract of my research. This paper analyzes the alignment between BYD's strategic expansion and the financial risks. It identifies, verifies, and resolves issues and then proposes conclusions and recommendations. Okay, let's start the context. Since 2020, BYD has formally launched its global strategic expansion. From 2018 to 2024, we observed a staggering 241.3% increase in its total liabilities. Problem: this raises concerns. Is this debt growth sustainable? Is it a sign of financial deterioration or a byproduct of healthy growth? My study aims to decode the intrinsic relationship between BYD's strategic moves, such as overseas plant construction and R&D investment, and its dynamic and solvency. To answer these questions, I employed a hybrid approach. First, I constructed a comprehensive financial indicator system encompassing both short-term and long-term solvency for longitudinal and cross-sectional trend comparisons. Second, unlike traditional static analysis, I integrated machine learning techniques. I compared the performance of XGBoost and random forest models in predicting future risk. Crucially, I utilized sharply additive interpretation values to open the black box of these models, enabling the quantification of how strategic variables drive financial risk. First, let's break down BYD's debt structure. Please look at this chart. Although total outstanding debt is deducted, the main driving force is contractual debt, which requires customers to repay for vehicles. In 2024, this proportion reached 23.5%. Regression analysis confirms that this is a benign debt driven by directives. In other words, BYD doesn't owe banks money, but rather owes the market for vehicles that haven't yet been delivered. This means that incremental ownership is healthy. However, strategic expansion is not without its costs. Empirical analysis shows that BYD's short-term solvency has experienced significant growing pains. In 2022, its current ratio was only 0.72, lower than that of benchmark companies such as Tesla. Why? Through correlation analysis, we found that overseas factory construction and high-intensity R&D investment have significantly squeezed the company's working capital. This is like a growing child whose nutrition is all allocated to bonds, resulting in very tight pocket money. If there's a pressure in short term, what about the long term? We discovered a very interesting high leverage plus high profitability model. Although its debt-to-equity ratio climbed to over 17%, BYD's interest coverage ratio reached 35.19 in 2024, even surpassing Tesla's. This indicates that the technological premium from strategic expansion and high overseas gross margins are sufficient to cover debt costs. This high leverage is sustainable. Next is the machine learning prediction section. After comparison, the XGBoost model achieved R-squared values exceeding 0.9 across all metrics, demonstrating superior prediction accuracy compared to random forest. Predictions based on this model show that BYD's short-term debt repayment risk will further intensify over the next 3 years, with its current ratio expected to remain below the safety threshold of 1.0. However, in the long term, although the leverage ratio remains high, the risk of a default remains manageable thanks to improved profitability. Why does the model make such a prediction? Through the SHAP value analysis chart, we can clearly see that the red dots are mainly concentrated in the negative value area on the left. This intuitively proves that as the proportion of overseas revenue increases, it has a significant negative squeezing effect on the current ratio. This verifies our hypothesis. Globalization's expansion is the core driver of short-term liquidity depletion. In conclusion, our research findings and recommendations are as follows. BYD's strategic expansion is a double-edged sword. While it enhances its long-term profitability through technological premiums, it also significantly squeezes its short-term survival space. Our advice to investors is, given the liquidity risk shown in the forecast, we recommend adjusting the expansion pace over the next 2 years to avoid overexpansion. Simultaneously, we should leverage current profitability to dismantle the temporary bonds used to create short-term structures, ensuring continued and safe global expansion. This concludes my summary. Thank you, and I welcome any criticism or corrections.